Good morning, James.
Hello, James. How are you?
I'm all right, thank you. Thank you very much for doing this, as I say. So James was on holiday. You remember we thought we had somebody else, and we got sort of let down, and then we booked this last minute. And James was on holiday, so I think he just sort of got landed with it.
Yeah. And if you hear small people running around in the background or that kind of thing, or doorbells, you'll know why.
Yeah, don't worry. Good. So I think, as usual, can we just sort of start off with sort of an introduction to Saints, please?
Yes, happy to. And hello to everyone who's listening and watching today. So Saints. Gosh, there's a lot of text on this slide. I won't bore everyone by reading through it. Let me give you the high level view of what Saints is about for those who don't know, who are not familiar with it. So Saints Scottish American is a trust that's been around for, well, we're coming up for our 150th anniversary this year. There are celebrations going on, so on and so forth. So a very long-standing trust. And at its heart, what it's trying to do, or what it's trying to be for shareholders, is a really sort of solid core shareholding that investors can build a portfolio around. Something that over a long period of time, shareholders can rely on to deliver them really good compounding and capital growth, but also pay out a really resilient and growing dividend along the way. So what we find is that within Saint's shareholder base, we've got two sort of different types of investor who it appeals to. One is the sort of classic income or income and growth investor who's looking for a really good, steady source of income that keeps up with inflation and grows. A bit like, James, you referred to that search for income outside of the UK. That's very much Saint's approach. It's a global trust looking for those kind of resilient and growing dividends all over the world. So that's part of the shareholder base, that those folks who are looking for that resilient growing income. But then we've got another part of our shareholder base who, are not really income investors per se, and what they're looking for is just this kind of steady growth, this steady compounding in capital and dividends and good total returns over time. And it really sort of works, I think, quite well for both of them, regardless of whether they are pure income investors or not. And I guess what you can see, we've just had annual results. You can see some of the highlights here on this slide. We've just increased the dividend, or the board has recommended a dividend 9% higher than 2021. That's the 49th straight year of dividend increases. Saints hasn't actually cut its dividends since 1938 was the last time it was cut. So it's been an incredibly secure source of income for shareholders. And you can see that, obviously last year, as we all know, was a more challenging one for income investors, particularly with income keeping up with UK inflation, which obviously has accelerated too. I think the average last year was just over 9%. So, really pleased that the dividend has grown again in line with inflation. In fact, if you look back the past 10 years, you can see that the dividend has actually increased a bit above UK CPI. So delivering real growth as well as a great resilience to that income stream. And yeah, the capital growth has also come through, and that has driven outperformance against global equities over that period of time. So I would argue it's been doing what it says on the tin, giving shareholders a really good compounding of capital growth, good returns, that resilient and growing income as well. And as mentioned earlier, and you see on the last bullet point, this is 150 years now for Saints, and hopefully there's another 150 to come. Probably not with me managing it for the next 150. That would require some kind of, I don't know, I'd need to dip into the International Biotechnology Trust or something to find something to allow that to happen. But hopefully many good years of growth still ahead.
Good, thank you. I mean, that dividend growth thing, I think, is actually quite important. I was casting around, I think I wrote an article on it recently, just looking for ways that you can actually get income growth that at least matches inflation, and most funds are failing to do that. So the fact that you managed to do that is quite impressive. Has that been done without dipping into revenue reserves?
It has, yes. That's a fully covered dividend. And the secret of it really is this isn't immediately obvious if you looked at Saints, but if you look back at the history, the past sort of 20 years, and the trust came across to Baillie Gifford to manage it about 20 years ago. What we've been doing over that period of time is progressively making it a more growth-oriented portfolio, as you probably would expect for a Baillie Gifford fund or Baillie Gifford managed fund. So the secret of it really has been that over a period of time, the names in the portfolio have become a lot growthier. That's been a gradual transition. We haven't done it overnight. It's taken a period of years to allow the, you'll know this, listeners will know this. Typically, when you're going into growthier names, they tend to have lower dividend yields. And so if you want to deliver dividend growth from the trust, you can't do that in a wanna sort of go into much growthier names, because there's a yield hit and a dividend hit. So over a period of time, as managers, we've been moving the portfolio into growthier underlying stocks. And that basically is what you've seen come through in 2022. The underlying holdings have been delivering really good sort of core earnings and dividend growth, and that's what's allowed the dividend to keep pace with inflation in the past year.
Actually, there's a sort of question that alludes to this, they're all coming through already. Talking about how you managed to manage the sort of balance between the defensive, sort of relatively defensive, income producing things that you own, like consumer staples, and trying to get the sort of growth as well. How do you go about doing that?
It comes back to trying always to take the long-term view for shareholders, I think, James. I think it's sort of saying, look, if we look out 10 years from now, what sort of rate of growth do we expect to come through from in earnings and dividends at this particular holding? How resilient is that likely to be if the world economy has a big hiccup at some point over time? And then making sure that within, there isn't a sort of magic number for the balance in the portfolio, but just trying to make sure that that there are names in there that have that incredible resilience, like the consumer staples and some inflation protection, but still a decent bit of growth. Maybe they're growing mid single digits, high single digits, but then combining those with some somewhat growthier names that can deliver double digit type of increases, and maybe they're not quite as resilient, and there's a bit of a question mark about whether they'd keep paying the same level of dividend in a crisis, that kind of thing. But making sure that both are well represented in the portfolio, and taking that long-term view about ultimately ensuring that everything that we own does have a good, solid growth outlook ahead of it on a 5-10 year view.
Cool. Okay. The structure little chart here in the bottom right hand corner. Can you sort of talk about that because it's unusual to have sort of property and bonds and things in a lot of your competing trusts.
Yes. So the logic here is that because we as managers, the board, are trying to deliver for shareholders real growth in income over time, and then the dividend growth as well as the capital growth, the logic is that the vast bulk of the portfolio should be invested in global equities, in companies that have good prospects of doing exactly the same thing. And so that's why you see sort of 98% of NAV currently invested in equities. That's dipped down sometimes 95, 94, something like that. But typically it's getting on 100% of NAV because that matches the real growth objectives of the fund. But then alongside that, making use of the fantastic investment trust structure, obviously the board has the ability to add a prudent bit of borrowing alongside that. And as you can see in that sort of 11% purple bit on the bottom right-hand chart, so there's a little bit of debt in there as well. And then the logic goes, well, why don't we use that, so the board's logic, our logic, use that to invest in things like property, bonds, a little bit of infrastructure in there as well, which hopefully, beats that cost of borrowing. And in fact, the debt obviously is nominal, and often these are real assets like the property and some of the other things that are in there. So use that borrowing ability of the investment trust to generate a little bit of extra income for shareholders, and also hopefully, with real returns that beat the return on that borrowing. So it's not a big part of the capital structure or a big part of what Saints does. The core of it is definitely this one around global equities for real growth. But, that's one of the great things about the investment trust structure. And so the board makes use of that ability to supplement the income and returns there as well. Cool.
To move. There's the chart here showing the dividend history, which is just underscores everything you've
yeah. We like to sort of point out we have crises, obviously periodically. We just had the COVID crisis, and it's not the first time that Saints has been through a crisis. And I think that the key point here is just a combination of the investment approach, so sort of the bottom-up focus on really resilient dividends from the investments, really resilient income, combined with the benefit of the revenue reserve, allows that fantastically resilient, dependable stream of income through a whole range of different crises that have occurred since the last dividend cut in 1938. In COVID, the trust took a very small amount out of reserves, but actually the underlying income held up extremely well during COVID. So although there was a little bit drawn on revenue reserves in 2020, that again was another year where the board were able to deliver dividend growth.
It's actually quite interesting how well you did with the high inflation period in the 70s as well.
Yes, I can't personally take any credit, but yes, the trust has, and I think so. We've been looking back at the 150 years of the trust, because the 150th anniversary is coming up. One thing that is really striking, and I think probably accounts for that, is that over the years, Saints has proved really quite adaptive to different times. It's had an engaged and interested board throughout its history, who've not sort of done it sort of on the side, but have been really, it's been front of mind of them to say, well, what are we going to do about this? How are we going to keep evolving the trust, and how are we going to keep this relevant to shareholders? That's as true today as it was in the 1970s. So I think what you really see there is the benefit, again, I would say, of an investment trust where you've got a good board who are constantly asking, right, what can we do? How can we evolve? And they've adapted and evolved many times over the years.
Cool. Okay. Right. I'm going the wrong way again. Sorry. So I know this says Belly of Global Income and Growth. That's the open-ended sister fund, is it?
Yes. Well, the team that manages, we manage both open-ended funds and Saints Investment Trust. They're almost identical. Obviously, Saints has the borrowings and so forth, but the name of the team is the Global Income Growth Team. So there are 8 of us in total, and both for our open-ended and for our trust structure, this is what we're all about. We're trying to find these growth companies. We're definitely growth investors to match the aims for shareholders, for unit holders. We're looking for long-term sustainability in everything that we invest in. Because we want to keep that dividend growth and compounding going through thick and thin, and that starts with owning underlying investments with sustainable business models, and we're looking for resilient dividends, again, to match the outcome for shareholders. And if we hold those for long-term compounding, and I think we've got a good track record of showing that we do what we say, we have an average holding period of about 8 years, then you put all those things together and you get the results, or we hope you will continue to get the results that we've been able to deliver, both from the open-ended and from the trust, regardless of whether you're an income or a total return client.
Does everything you hold have to have a dividend?
Yes. Well, the strict rule that we have, to give you the detail, is it either has to pay a dividend, or we have to have high conviction that it's going to start paying a dividend within the next few years. So occasionally, and it has definitely been the exception rather than the rule, we have bought things before they've started paying a dividend. Notably, Apple, back in the sort of 10 years ago, we were pretty convinced it would start paying one, and we bought it before then. That's worked out very well. But by and large, vast majority of cases, it must pay a dividend. I think the difference probably between us and folks listening will recognize this, I think, and know this, us and other income trusts, is that we're prepared to go right down the yield spectrum. And I think you will see this actually on the next slide. I think we've got the portfolio slide in. I don't know if you can click through, James. It might be the next one or the one after. But yeah, there we go. So we're because we're very much long-term oriented, we're prepared to take the long-term view and say, look, even if it's a 0.5% yield or 1.5% yield today, if we see that compounding away and growing really nicely for the next 10 years, we're prepared to invest right down the yield spectrum. But we do want to see a dividend.